Alrighty, folks. We're going to hit off. This is a pretty eventful day of earnings, so we're going to have several videos tonight, probably 3. We're going to start here with Uber. The rest, we're probably going to hit up Roku, maybe a little Cloudflare as well. So let's go ahead and get it cracking with Uber, who is down 2.1% after hours, a little bit below where they started, or by a little bit below where technically they would have started the day at. So interesting stuff. Obviously, look at the history of the stock here. Kind of crazy. This is a stock that's up 35%, and at one point, was down massively, down 50+%, because they've lost half the revenue for the year. But you know what? This stock just doesn't seem to care. Year to date, still going a little bit buck wild. And I got to be honest, I don't necessarily know if I get it. We'll take a look at these earnings and see if there's anything super exciting. I expected some massive revenue drops year over year, obviously, because, well, I think it's pretty obvious. This is a stock that's going to be getting hit hard. Ride sharing is an area that's really heavily restricted right now, and due to actually recent trends, I have a bad feeling that it's going to be heavily restricted for quite a while after this. So I'm curious on this. They posted a GAAP EPS of negative 62 cents, missed by 2 cents. It's not horrible, but you do need to mention, obviously, this is a company that said by 2021 they would hit GAAP profitability. Turns out, I don't see that happening at all. There's not a chance at this point. They had a good thing going, a good streak going potentially, where they could have gotten to that point, but I don't see it possible now. I think they're going to be hurting for the next 2 to 3 years now because of everything going on this year. So, revenue of $2.81 billion, misses by $380 million, is down 20% year over year. Now, let's be fair. That is definitely a massive revenue decline. Last quarter was something like 50%, 40% revenue decline. So it's an improvement on that. I gotta be honest, there's an improvement on that. But it's not a good looking number. It's not good. I don't think anyone can argue that that's not an ugly number. And I think next quarter will be, honestly, it's pretty ugly. I mean, you see some reopening in the economy. It's good. But I've got a bad feeling there's a chance that we go back towards that area where we maybe don't have access, free access of everything like we did before. And ride sharing is a very expensive, unsafe, method potentially. There's a lot to consider with ride sharing. That's my concern. Gross bookings are 14.7 billion versus a consensus of 14.64. So good on that. Trips of 1.77 billion versus a consensus of 1.14. A lot of more trips than they expected. Pretty big there. And monthly active customers of 1.0 or 103 million versus a consensus of 73.7. They are good numbers compared to consensus. So the recovery has been quicker than expected for sure in terms of people using the service, but my concern is still with the overall data there. I just don't like it. I overall am not a huge fan of that right there. So let's look at the press release, see if there's anything interesting here that we need to see. Very curious. Financial highlights, obviously we need to see that. Gross bookings declined 10% year over year. Mobility gross bookings declined 50%, which is not a shocker. And delivery gross bookings grew 135%, and that's obviously for the Uber Eats platform, which I think is really the only thing that should be holding this stock afloat. But again, it's the minority category of this business, unfortunately. Mobility revenue declined 53% year over year. 53%, holy crap. Delivery revenue grew 125% though as a result. So there's positive there. But I don't know what you need to say. The main portion of their business, the mobility business, is taking a hammering, and it's going to consistently take a hammering, unfortunately. Scary stuff. Net loss was $1.1 billion. Son of a gun. This is a stock that at one point before, it was a pre-COVID thing. They lost $3 billion in a quarter. $4 billion in a quarter, I believe it was. So 1.1 isn't the end of the world. I don't think it's good by any means. It's definitely not a good number. Losing $1 billion in 3 months is horrible, especially for a company that's not had profitability ever in its history. It's just a scary trend of how sustainable is this in the long term if they can't find a path to profitability, Yeah, definitely, definitely something to consider there. And what you really need to consider too, which is crazy, the delivery adjusted EBITDA loss is $183 million. It's a loss. The delivery segment is not profitable by any means. The delivery segment brings them down. And not only that, you see an issue with the mobility segment as far as that's concerned. So they have two businesses right now, both unprofitable, one growing and one that's getting absolutely hammered this year. It's a weird stock to think about, for sure. Really weird stock to think about. Yeah, I don't know. It's weird. As far as these charts just pretty much describe exactly what we just talked about. Nothing crazy, mobility adjusted EBITDA shrank 61%. Now, delivery, it actually did rise, so there's positivity there. So there is positivity there. So, you gotta find some good things to talk about, right? Well, it'd be rude if you don't talk about the good things. Overall, by segment, obviously, as we saw, and freight's in there too. Uber Freight could be, they're really ramping it up to be a pretty big portion. You do need to mention, obviously, the delivery numbers. They look good. They really do. As far as that 125% growth, that's sustainable, which I don't think it is, unfortunately, but I do think it's a trend that's continuing. It's good growth. To our overall, see total revenue only fall 18% it's a positive number. I suppose so. In the mobility segment. So, apparently, as they're saying, it varied by region. I'm going to... I think I just blew my entire brain out of my nose. And I want to die. So, overall, mobility gross bookings were down 50% year over year, with EMEA down 36%, Latin America down 40%, Asia Pacific down 52%, US and Canada down 59%. So again, they'll say varying by area, but honestly, all these areas sucked. All these areas just sucked. I don't know what you want to say there. I don't know. Continued innovation and safety. They've got a no mask, no ride policy. Good for them. That makes sense. But again, there's just a lot of concerns there. I don't know. I think there's definitely some interesting concerns. I think working anywhere technically, but I don't know. I feel like there could be some legal issues potentially locked into a little car with someone, especially with a virus out there, highly contagious. I don't know. It's weird to think, but maybe not. Interesting stuff. Interesting stuff from a delivery perspective, as we saw, obviously, across the board strength, triple-digit growth in Canada, U.S., Canada, EMEA, Asia Pacific, and Latin America. So 100% over on all of those segments. Pretty good. UK and Canada close to 200% growth there. Pretty cool. And Japan and Spain growing in excess of 300% year over year. That is good numbers. I give them credit. I give them credit for that. So that's it for Uber as far as what I want to talk about the business wise. I do want to bring home this balance sheet as we do. On the right is your most current, because I have a lot of concerns. If you lose $1.1 billion, I've got some concerns. The 9 months overall comparison. Total current assets right now is $9.4 billion. That's versus 13.9 previously. Total assets in general, 28.8 versus 31.7. I don't like a declining balance sheet. I don't, and I'd like to see liabilities. I'd like to see liabilities shrink if the assets are. It's not going to be the case with this company, unfortunately. Right now, total liabilities of $18.7 billion versus $16.5. Not good overall numbers, but it's not crazy to see it rise because of the current situation. You can't blame them for that. There's a lot going in their other side. I just wouldn't necessarily think this is a good one. Stockholder equity has decreased now to 9.6 versus 14.8 billion. It's not good. It's not a good position on this balance sheet. I mean, if these trends continue, you're talking about, it's been over 3 quarters, so it's not awful, but if you have a full year still after this with declining revenue like this, profitability where it's at, you're liable to see this potentially turn into a stockholder deficit. I'm not going to say it's get to that point. I don't think it will get to that point, but this balance sheet's going to continue to shrink for the next couple quarters at least. So I think there's concern there. Now, they can definitely raise capital, but again, that just adds a debt load, and the recovery is the concern. I can't fathom buying this stock right now. I can't. I don't know how it's up on the year. I don't get it. You're talking about clothing retailers, which are in a similar boat here. The only thing is, this has obviously, it's got one good segment in the delivery segment. Their core segment is awful. It's been overtaken. And it will be for a while. That's my concern there. Revenue this year is going to be closer to a 12 to 14 billion number, and trading a market cap of 73 isn't horrible. I just don't see the value in trading the stock right now, unfortunately. So I don't think this one's worth buying. Just gonna be honest. Hope you enjoyed though.